In the previous video or the previous slide, what we saw was what are the various additions which are to be made to the profit as per profit and loss account. Let us now see what are the deductions to be made from the profit as per profit and loss account. Now please note, as I said, the word profit is very important here, because if your profit and loss account shows a loss, then instead of reducing these numbers, these have to be added. And the reasons for that we had discussed in the previous slide as well. So let me just explain each one of them separately to you. Although I am sure because you have understood these concepts in the previous slide, you will be able to get through these very easily, or actually sail through these. The first one is expenses which are specifically allowed for income tax purpose but not debited to the profit and loss account. Now let us see what does this mean. Let's say your profit as per the profit and loss account is 100 rupees. Okay, there are some expenses which are specifically allowed under the Income Tax Act. Okay, let's say for example, if I were to give you an example, let's say depreciation. Okay, let's say for example this depreciation is not allowed under the Companies Act. Okay, so therefore there was no depreciation charged on a particular asset. But if that depreciation is chargeable under the Income Tax Act, then we reduce that depreciation from this profit, whatever that number might be, and arrive at the net number of profit after that. So if this depreciation is in the nature of an expense which is specifically allowed under the Income Tax Act but not under the general company rules, then it's an expense which is specifically allowable and hence deducted. Right? The second one is expenses relating to the previous year but not debited to the profit and loss account. Now let's say for example we always saw something, something like prepaid insurance. Let's say in 2011 you paid 500 rupees for insurance, out of which 250 pertains to the current previous year. Okay, let's say for example you did not charge this 250 during the current year in your profit and loss account. Then in that case this 250 has to be reduced from the current year's profit to arrive at the net profit. Right? The third one, losses allowed but not debited to the profit and loss account. Again, it's something similar. Something was to be charged to the profit and loss account but you did not charge it. Hence, you have to now reduce your profit and loss account by that number. The next one, income or receipt not taxable under this head but credited to the profit and loss account. Let's say you have a profit and loss account which was given to you, okay, which had, let's say, sales 100, interest 30, expenses 50, profit 80. When you prepare your tax computation, you start with this number. So you say your profit as per profit and loss account is 80 rupees, right? But this 80 rupees also includes this interest income, right? Interest, as you will learn further or you may already know, is taxable under the head income from other sources. So what is happening here is there is an income which is included here, which is reflecting in your profit as per profit and loss account, which is not chargeable under the head profits and gains of business and profession. So you have to basically exclude this. And how do you exclude it? You exclude it by reducing it. The other reason is that if this interest was not there, then what would have happened? You will have 100 as the total. You would have 100 here and your profit will actually be 50, right? The same thing I did here, well, instead of doing it directly, I indirectly reduced it from the profit as per profit and loss account, right? please try to understand the reason for each and every adjustment, because when you get your question, it's these reasons which are going to make you to do them. Next, income or receipts taxable under other heads of income but credited to profit and loss account. This is actually one and the same thing here, right? There's no difference between the two of them. So for your notes purposes, you can ignore this one, right? Other expenses not forming part of income but included in P&L account. So let's say, for example, your adjustment to stock figures. So if there's no adjustment which is there in the profit and loss account, these adjustment to stock figure can actually be expenses or income, but what we are talking about is an expense. So let's say there is a reduction in the value of the stock. Okay, that's an expense. Okay, ideally what you do is you show it by way of two things. Normally you will have opening stock or closing stock, and the difference between the two gets adjusted by the difference of these two numbers. But if for some reason this is not done, okay, this reduction has to be shown by way of a deduction from this profit and loss account, right? You will understand each one of them in more details as we move forward, but as of now, just keep these broad principles in mind.